So good afternoon, everybody, and welcome to a bit of an overview of what we've seen in the 2020-21 ProfitProbe benchmarking work. And just want to start off with a bit of a summary with what is management accounting. So that's what ProfitProbe benchmarking does, and all the analysis work that we do. The focus on this is in management accounting. And so there's three primary differences with management accounting as opposed to cash and taxation accounting. And they are that it takes into account the cash and non-cash movements. And we'll come back to this again in a moment. So we've got our cash and non-cash. And we've also got our cost separation. So splitting out direct costs as opposed to overhead costs, as opposed to finance, tax, and CapEx, which is important when we're chunking down the business to actually see what's making it tick, what's working, what's not working as well. And we've also got the market valuation of assets involved. So to the best of our ability and your ability, what is the market valuation of your assets? So they're the main differences. It's actually not a huge amount. However, they're fundamentally important when it comes to analysing a rural business. Now, use the analogy of a bucket here. So filling this bucket, or this bucket here is your gross product bucket. And what fills that is your cash movements, so your sales less your purchases. And this is an important part of the business with regards to gross product, because your sales are showing, well, how well, particularly at the moment, how well are you capitalising on the current market values? And so one of the things I've observed with all the variations that we've seen in prices over the last 15 odd years is that there's spectators and then there's competitors. And if you're a spectator in the market and you're not actually involved in capitalising on these good prices, well, then they may as well not be high. So we've got to make sure we're realising these markets. And then we've got our purchases, which is looking at, well, how considerate are we with our buying? Next to that, we've got, and the other bit that fills this bucket is the change in inventory value. And that's a non-cash movement. So we don't, there's no transactions on your bank statement they're going to match up with this. However, it's an important part of filling this bucket. When we're looking at this change in inventory value, there's two different approaches we take, and that's for your trade or growing animals separate to your breeders. And so I've just used cattle here as an example. If we were to look back through time, here you can see that the breeders open and close at the same value through the year. And the change in their valuation from a benchmarking point of view occurs at midnight between years. And so we've jumped up to a much higher valuation for the breeders this year. Your trade animals open and close at market value. So they shift with the market. And the reason for this split in approach is that with your trade animals or your growing animals, the intention and the purpose for having them in the business is to sell. So they're there to sell. So the value is added from your trade animals via this increased growth and their value. So if you've got a feeder steer at the moment, your decision to not sell it at current market values means that you are buying it off yourself at current market values, to use the Bud Williams KLR approach. So you're exposed to these market variations because those animals are there to sell. When we're looking at our breeding animals, though, the intention with your breeding animals is to keep them. And so the value is added from any breeding animals, your ewes or your cows, via their weaners and also via their sales, so the ones that you actually sell. So scanned in lamb empty or preg-tested empty animals or cull for age, they get sold. So you realise the market value on those and you realise the market value on your weaners, and that's how they add value to a business. What we don't want to do is go changing your breeding animals through the year. Because they're a long-term asset, you're going to get an unrealistic value, an unrealistic measure of gross product in your business if you go shifting this between years with assets that you don't intend to sell. We've had a pretty close look, and we're obviously going back a long time. We've kept a very close eye on the difference between the Eastern Young Cattle Indicator and the National Trade Lamb Indicator. They're the two that we use for looking at our market valuations to put that valuation on trade and breeding animals. So if we compare here ECI to ProfitProbe, it's shown it to be very close. The differences between what we're using and what people have been actually receiving for the price of beef has stayed pretty close, and that's given us confidence in the assumptions that we've made. Once you fill this gross product bucket, we've got our cash and our non-cash shift in here as a measure of our true income. We then have some holes in this bucket, so we've got to pay our direct costs and our overhead costs, and it's important to know the difference between those two areas. And what's left we use to calculate your return on assets, and that's on market valuation of these assets. And then we've got to pay our finance costs. Now, this is your interest costs, so the cost of servicing any debt that you might have. And we've got to make sure that we've got enough coming into the gross product bucket to pay for our direct costs, overhead costs, and finance costs. This is for short-term survival each year. And what's left there we call business profit. And so when I refer to the expense ratio a little bit later on, that's what I'm referring to here, is what's the relationship between how much is coming into the bucket versus what's going into paying for direct, overhead, and finance costs. So we want to make sure we've got more coming in, obviously. What's left after that, we've got this business profit. However, this has got a hole in it as well, and that's to go into paying tax. However, it's important we look beyond tax. Tax is a cost of running good business. So we need to budget for that, just like we would any other cost, and get excited about what's left in this bucket here after paying tax. So this is business profit after tax. We'll abbreviate that as BPAT. And it's out of this bucket here that things get exciting. This is where we can pay ourselves a dividend. This is where we can do some debt reduction. This is where we can spend some money on capital expenditure and investment in our property, or we can build some reserves in the business to get us through the more skinny years. And I think breaking down your business into these different components is really important. The end goal is to fill this BPAT bucket, because I reckon this is your freedom bucket. For long-term survival, you've got to generate a positive business profit after tax, because if we're not doing any of these three here, your business is going to be short-term surviving. So looking at some of these strategic KPIs that we've got, and the goal with any of these KPIs is to trend the right way in your business. And it's look at what other people are doing. That's important, that's useful. What's more important is to look at how you're trending. The high level one we've got is return on assets, and that gives us this overall perspective of how our business is performing. However, the problem with return on assets is that it doesn't tell us why or what the reason is for the good or bad result. So if your return on asset result isn't a good one, it doesn't tell us why. And this is where these next three come in. We've got our turnover ratio, our gross margin ratio, and our overhead ratio. So they're our three secrets of profit there. So they tell us the reasoning behind a good or a bad return on assets. A couple of other high-level strategic KPIs we're going to look at are your finance ratio and then the expense ratio. And the expense ratio looks at the relationship between total value generated, which is your gross product, and the total costs expended to generate that value. And it's a nice, quick and dirty one to look at how efficient your business is. So what do these ratios tell us? Let's just do a quick overview and then we'll dive into it and have a look. Return on assets tells us how much did our invested assets earn us. So what is the earnings before interest and tax against our assets under management? And then we've got our three secrets. So gross margin, out of the value we generated, so that's that gross product bucket, what's left after paying for our direct costs? So we're just breaking down your profitability in a few different chunks. And gross margin's the first one. We've then got our overhead ratio. Out of the value we generated, so that gross product bucket, how much of that is going to paying our overheads? And then our third secret, turnover, tells us how active is your asset. So what's the total value generated as percentage of the total asset? And that's just really, think of it, if you've got a business with a 10% turnover, it means you're generating value which is worth 10% of your total assets. And we'll come back to that again in a moment. The other couple of strategic KPIs we talked about was finance, out of the value generated, out of that gross product bucket, how much is going to servicing your debt. And then we've got our quick and dirty expense ratio. Did we generate more than we spent? And that's what I love about this one. It's just nice, quick, dirty overview. How are we going? So let's have a look and let's unpack that bucket into what we call the economic planning process. If you've done stuff with us, you know we actually call this the 4-play model. 4 people learning about economics. So we've got our stock flows and crop flows up here, and they are the most fundamental starting documents. We can't do anything else unless we've got confidence in your stock flow and crop flow. Once we've got confidence in that, we've got all the information we need to do the trading account. And if we think back to the bucket, here's our sales less purchases, that cash movement. And here's our change in inventory, that non-cash movement. So that's our gross product. And then we do our gross margin analysis. So we take our gross product and take away our direct costs. And this is where that separation of costs becomes so important in your chart of accounts or your list of categories in your accounting program. And then we take out our overhead costs, gives us our EBIT, take away our finance costs, gives us our business profit. And then we can take out tax, and we've got BPAT. And when we've got BPAT to go to CapEx and dividends and other changes, and that tells us how we got from one balance sheet to the next. So there's flow of documents. If you're watching this, you most likely have done ProfitProbe this year, so you've got access to those training videos that step through this in more detail. Or if you're booking a session with an advisor to go through your results one-on-one, we'll explain that again as well. So let's have a look at the results and what are we seeing as an industry. Let's look at return on assets first of all. Now, return on assets is taking your EBIT and dividing that by your closing ag assets, times it by 100 to get to a percentage. And our benchmark with that is to be consistently greater than 6-7% in there. That's the goal that I would be setting for any business to strive towards, assuming that you own your land asset. And here's what we're seeing over the years. And I've got the graph going back to 1999, keep it in that 20-odd year range. And you can see the green lines here refer to the businesses that are in the top 20% as measured by return on assets. And whenever we refer to top 20%, we'll always be looking at the businesses with the highest return on assets. So when we look at them in a moment, we'll look at the top 20% gross margin ratio. That's going to tell us what were the characteristics of these businesses in here with the highest return on assets. So and then the blue lines in behind here, that's an average of all the businesses and all the data that we've analysed. On average, there'd be about 100 businesses per year in the data sets, in that vicinity. Some years a bit less, some years quite a bit more. And the black lines that you'll see are the 3-year rolling averages. So for the last 3 years, the top 20% have achieved a return on assets of just over 6%, and the average is about 2%. So hopefully that makes sense between the different colours there. If we look across time, you can see there's been a lot of pressure put down on return on assets, and the increasing land prices are one of the contributing factors for this. What I find personally really interesting is that there hasn't been any substantive change in the average return on assets for a long time. And I'd say really right through time. We had that one bigger year here where if we look at the top 20 though, back in 2000, 2001, they generated the return on assets of 14.7%. The average producers did well. They were about, I think that was 5.6%. Compared to 14.7, not quite as attractive. Take that year out, and I'd say that this 3-year line really isn't going to shift much. Everything kicked up a bit there. So, I believe that this is a really important takeaway that I'm thinking with ProfitProbe is that one of the main determinants of profit is a lack of clear goals. And I unpacked this a bit more with the crew at the Townsville Grazing for Profit that just finished this week. So my voice is a bit scratchy, that's why I've just come out of school. So I just look at that. The fact that it hasn't changed and I'll put some data up later to show how much land prices have changed, to show how much seasonal variability we've had, and in the last few years, how much our commodity prices have shifted. So we've had all this fluctuation and yet not much change there. So I believe that being really clear on your business profit after tax goal, having really clear profit objectives for your business and connecting your goals to your profit requirements and having real ownership of what profits you need is a critical component to generating return on assets. And I'm happy to unpack that more with people one-on-one if they want. Another couple of interesting things here. If we look, we have this massive increase in return on assets. And if you can remember all the way back, this is when we saw the cattle market first really take off. So we saw a 48% lift in the trade cattle prices between the start and the end of the year, which was 85 cents a kilo. It's huge, wasn't it? We thought everything was going pretty well back then. What was interesting is if we look at the 2019-20 data, the trade cattle market clicked 56% there. So it kicked by even more. So it was 143 cents per kilo increase in that market through that 12-month period. However, the return on assets was 3.7% less from this year to that year. And then if we look at this last year, there was another increase in market again. Who would have thought it? And cattle market was 21% higher, which was 84 cents a kilo, which so we're still seeing increases in the market. So we're still seeing that revaluation of trade animals. However, it's not coming through at a return on assets like it did when it first happened. And that's worth understanding what this has meant for your business. So whenever I put these numbers up here, I want you to think, okay, that's interesting. What does this mean back to my business, and take it back to your results? The final thing I'll mention this, if we look here, we've got a 20% increase, and that was 84 cents a kilo, and that's the same as a 48% increase a few years ago for that same 85 cents a kilo. So the cents per kilo has gone up, but what percentage shift that was in the market is substantially different. When you're looking at your results, so you'll see your financial year results there, and when you're looking at your KPIs, it's a reminder that all of these KPIs that recur under the top 20% column are the characteristics of the top 20% based on their return on assets. And then when you see a 3-year average figure, I'm not going to refer to that any more today, that's the 3-year rolling average of the top 20. So that benchmark number is a really nice number to look at. It takes out a bit of the fluctuation that we're always going to see with markets and seasons, etc., to show, well, what are the top 20% done in the last 3 years? So let's have a look at the 3 secrets and see what they've shown us. The first one I'm going to look at is your gross margin ratio. And that's calculated by taking your gross margin, how much is left out of gross product after paying for direct costs, and looking at that as a percentage of gross product. So what's our production efficiency here? How much is left after paying for those direct costs, those costs that are directly related to the number of head you're running or the number of hectares you're farming? Our benchmark goal for this is 65% and to be consistently greater than that. And we can see here that the green lines, the top 20%, the businesses with the highest return on assets, have been consistently higher than the businesses generating the average return on assets. And if you can see how these 2 lines are kept, the black lines, which is the 3-year average, how there's a big gap all the way through. What that tells us is that gross margin and the gross margin ratio being achieved is a very strong driver of return on assets, because there's a very clear difference every year through here, which is why it's one of the 3 secrets of profit. Since that cattle market came up, we've been seeing this top 20% really consistently sitting in that mid-60s to high 60s range, with the exception of 17-18 when there was a bit of a price correction. We've seen a lot of fluctuation with the average of everyone who's benchmarked, down as low as that was like 34% here, and up as high this year is relatively very strong at about 62%, which is really nice to see that this underlying bit of profitability running around. Again, where are you operating? How are you trending would be the question that I'd come back to with this. What's actually going on in your operation? Your goal with this is to keep your gross margin ratio high and to really know what it is, which way it's trending. There's gross margin, your gross margin per hectare, your gross margin per LSU or DSC. They're all really powerful numbers to understand in your operation. The second of the 3 secrets I'm going to go through is your overhead ratio. This is where we look at the amount of money that's spent on overheads. Now, this includes your non-cash overheads of depreciation and unpaid labour if you're not paying yourself a market wage, and looks at that as a percentage of your gross product. So out of all the money that came in, what percentage went to paying for the overheads? And our goal here is to be consistently less than 35%. So for every dollar you generate there, we want to be spending less than 35 cents of that dollar on overheads. And if we look and see what the industry's been doing, well, I just want to draw you to the green lines here. So what are the businesses with the highest return on assets been achieving at an overhead ratio level? And it's really consistently down at that 30%. So I say 35% sub, I'm probably being a bit kind, to be honest, because I think that sub 30 is definitely a target to look at. And if we just look at that consistency and we look at the difference between those businesses with the highest return on assets versus the whole cohort, the whole group being benchmarked, that's a huge gap. I'd say on average here, we're looking at about a 25% difference on average between the top 20% and the average, which means there's a difference of 25 cents in every dollar generated that's going into overheads. Again, it's a really strong driver of return on assets, of profitability here. Which way are you going? Which way are you trending? If your overhead ratios or your overhead levels aren't at a good level, you've only got two options with that. You can either cut your overheads, which is a matter of going through and really challenging each cost item, making sure you're getting on the phone to your phone company, and getting on the phone and getting quotes on insurance and going through each line item and really challenging how is it contributing to your business. If you can't cut them and you want to make sure that you don't starve a profit into your business, then your only other option is to dilute it by increasing gross product. So you've only got two options. And so if it's out of whack, see if you can cut them any further. If you're already operating at really high levels of efficiency, and I know a lot of people in the client base are, they're not extravagant with their overhead base, so it really comes back to increasing turnover as being the only option. An alarming trend we've been seeing in the overhead space, if we look at this on a per LSU, or it's the same trend on a per DSE basis, you'll see that the overheads per unit has been going up and up and up and up and up. And so this year, we're actually seeing the overheads per LSU getting up closer to that $190 per LSU, and it's 187 thereabouts. That's a huge shift when we think back to not very long ago, through the 2000s. The top 20% was sitting around that $40 per LSU and the average around that 60. And now we're talking over 180. So that's a trebling in the overhead costs per unit that you're running. What's behind this? Well, I'll dig into that a little bit later, but I think what's most important is that you unpack what's behind this in your business. You notice the top 20% have leveled out this few years in terms of being able to manage that overhead situation. So that overhead efficiency is a big driver. The last of the three secrets is your turnover ratio. And this looks at the value being generated, so that true economic value of income, your cash and non-cash, as a proportion of your total assets under management. And this is only your ag assets. So those of you who have put in ProfitProbe and you've included share portfolios or off-farm assets, those numbers aren't included in your KPIs. It's there for you to be able to see your equity ratio and how that's trending. However, it won't influence this. So if you've put that in, that's fine, don't worry. Our goal with this is to be consistently greater than 10. I would prefer to see you setting a target of greater than 12 myself. I think that's a nice one just to keep us striving for a really solid result. When I first started doing this, our benchmark goal was consistently greater than 15%. So we've actually, with these increasing land prices, we've brought this back a bit, but let's have a look and see what people have been achieving. In the green bars, the businesses with the highest return on assets, through here, up around that 20%, through this 2006 to 2017 period, pretty consistently around the 15, and now we're sitting at around that 12 mark there. And the average, exactly the same trend if you look at the two black lines there. However, that average result now is getting around, sitting in that 5 to 10% range And we want to be getting that up over the 10 and just making sure you've got more activity, more return coming off that big investment that you're making in the asset. So we've got these big lazy assets. We need to be challenging this. And with turnover ratio and using this for your business, rather than just looking at where your result is compared to these numbers I'm talking about, compare yourself to where you were 12 months ago and where you were 12 months before that, and really focus on the outcomes of you implementing your management strategies as to which way you're trending. Once you get to the end of the 3 secrets, if you go to the end of your reports that you've been sent, you've got this little profit tree, a diagram. So once you work out where your dead wood is, if it's in gross margin, then go and dig into your results a bit more and use the help videos that are there to work out, is it a gross product issue or is it a direct cost issue? And then depending on that, dig deeper, go in and have a look and see if you can find something that you can specifically focus on this year to improve this ratio. And that's what's going to flow through to improve your return on assets. So we're going to start at the strategic level and then finish at a tactical level to work out what you're actually going to take action on. If it's in overheads, is it a land-based building and plant, labour or admin issue? And then dig into them. Go and have a look and see what's going on in your operation. Which way are you trending? If it's turnover, is it a stocking rate or activity level, or is it a scale issue? So, even those of you on small scale, gross margin ratio, doesn't matter what scale. You want that gross margin ratio to be greater than 65%. If you're on small scale, what you're going to find is that your overhead and turnover ratios are going to struggle. But there's no excuse for a low overhead. It's no excuse for a low gross margin ratio. So if you're down these ones, dig in. Just use that as the process. Start strategic, make your decisions tactical. Last couple of these strategic KPIs, we've got the finance ratio. And this looks at how much money is going into servicing your debt. This is your interest and borrowing costs relative to the total value generated, gross product. Now, the benchmark here, it does depend on your return on assets. Generally, you want it to be sub 15. However, if your return on assets are 0, then your EBIT is going to be 0, which means you don't have any cash left to apportion to servicing debt. Because if your EBIT 0, you haven't generated enough value to pay for your direct costs and overheads, let alone servicing debt. So the higher your return on assets, the higher your capacity to service debt. We've seen a lot of fluctuation in this over the years. Pretty consistently, the top 20%, if you look at that 3-year line, they have a much healthier finance ratio. So the amount they're paying to service debt is much less than what the average producer is having to, as a proportion of value added. You'll see that we're back at very low levels here. And one of the prime reasons for that is where gross product is being supported by high commodity prices, and interest rates are at all-time in all history of business low levels. They've never been seen now. So I'd expect it to be there. With your budgets, with your forecasts, go and start putting in 5, 6, 7% over the next 5 years in your 5-year budgets and just test how resilient you are. I don't know what the interest rates are going to go to. I just wouldn't budget on them staying where they are now, just from a safety point of view. I find these two graphs interesting here. I think it's important to come back to. This is that finance ratio graph that we just looked at. So the relationship between how much is going to servicing debt next to your gross product. And this one here is the debt per LSU, the same trend per DSC, so the debt per annual unit. And what you'll notice here, I'll get you to point out, see these black lines, how they cross. When you're seeing those 3-year rolling average figures for the top 20%, the average crossing, what that tells us is that there's no relationship between this particular metric and return on assets. There's no distinguished difference. And if you compare that back to the overhead ratio or the gross margin ratio, there's a really solid, what I refer to as white space. And this white space we're seeing here, this big gap, shows us that finance ratio is a strong driver of return on assets. A little bit less in these years, but across the years, it's very strong. This one here, I'd say there's absolutely no relationship between the amount of debt per unit and return on assets. So it's not the amount of debt, It's how it's used, where it's been, what it's been used for, the reasoning for the debt. Last of the big ratios is your expense ratio. And this is where we take all your costs, your direct costs, your overhead costs, your finance costs, and we look at that in relation to the total value generated. Our goal here is consistently less than 65%. So for every dollar that you generated, we want to have your expenses less than 65 cents in that dollar. So you've got 35 cents in the dollar left to go to paying your tax and then into that freedom bucket. So dividends, capital investment, debt reduction, etc. What we're seeing here, I mean, there's no surprise there'll be a big difference between top 20% and average and return on assets. What's been nice to see, if we look there, that's 100%. So if you're over 100%, in economic terms, you're spending more than you're earning. And we've had some pretty scary years here. And through this period here, we were consistently, was it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 out of 13 years there, the average producer was spending more than they were earning in economic terms. It's only been the commodity prices in this last few years here that's really helped with that. Are we going to maintain where we're at? I don't know. What was interesting is when the commodity prices came out and came off a bit, and seasons are a bit tight, the expense ratio jumped up to levels we'd never seen, which to me indicates a bit of fragility in the setup there. So know where yours is. How's yours performing? How much resilience, how much fragility have you got? How much scope have you got to withstand some external hits? When we're looking at labour efficiency, this is my go-to for labour efficiency, and that's your gross product per full-time equivalent. FTE is full-time equivalent. So for every full-time labour unit that you've got, how much gross product are they generating? And I think this is, I like animals managed per full-time equivalent too. I think that's a good one to look at. And your top 20% this year are sitting still around that 1,400 LSU gross product, does 1,400 LSU per full-time equivalent. However, some of you are running much higher value enterprises and you're running mixed enterprises. So the LSU or DSE per FTE is a good one, but it doesn't give us the complete picture. I like this one. So, it doesn't matter what you're doing. If you're finding that your labour units aren't generating value, then they're not going to be able to cover their cost of labour. You can see we're long time here. We sat around that $300,000 to $400,000 per full-time equivalent. Then we jumped up to around that $550 was the benchmark I was using through here. This last couple of years, you'll see the top 20% have blown the $750,000 gross product level. And averages even come up to that 500 to 550, which is just really nice to see what's happening there with it. Where's the new benchmark? Where's the new level? I'm still probably back around this 550, 600 year in, year out, and I'll reassess that one next year to be honest with you. Again, come back to how are you operating? How is your gross product per FTE this year compared to last year? And if you want to strive, well, there's your top 20%. 750 to 800,000 the last 2 years. And again, look at the white space through here. It's a strong driver of profit, is this labour efficiency. It's not telling us how many labour units we're running, it's what's the value generated per labour unit and how effective are the decisions that they're using and how efficient are they in their work. A couple of bonus trends, and I'm open, if you've got questions, just chuck your hand up or chime in as we go. But I've got a couple other graphs because you probably haven't had enough just yet. And the purpose with all these is just to get some thought going, to try and get you considering a few different areas. And I want to start with this one, and I want to compare a few different industries. This is your dollars per tonne received for wheat going back to 2000. So you can see here going through, there's been a bit of up and down, and it's definitely on average probably a bit high, but there's really not much shift in the wheat price, particularly when we compare that to what's happened to cattle through a similar time frame. So pretty flat through here. However, since this 2014-15 year, we've seen, obviously, this cattle market really take off. And the sheep market has done something similar. Okay, the sheep market stayed up a bit higher. It just hasn't gone to those same highs, but the sheep market has really consistently increased here now for 8 years, and it's been very, very strong performers. So what is the relevance of this? How do we use this information? And for me, it just depends on where you are and how you're located. The big thing that stood out to me when I pulled this information together and compared it is that what was a profitable model of operation back here? So what would have worked as a business really successfully for this 10, 15 year period here? Is it still the most efficient or most effective or most profitable model of operation for now? Because I look at this in terms of we're playing on a different playing field now. And we're not just a different field. The field shape, the shape of the field is completely shifted. We have playing by a different set of rules. And I think mentally and within your what-bes within your business, if you're mixed farming, this needs to go into the picture there and to see, well, right, what role do livestock play? And to throw an extra curveball in there, this will make some of the croppers break out in a cold sweat. That if we think about the importance of livestock in a cropping operation as well for soil health, and I think there's really some pretty compelling arguments. I want to just put this one in, and this is about beef price received, and I could pick up any commodity over the years, and it's the same thing. This is looking at the actual price received out of ProfitProbe, so the average farm gate dollars per kilo that a business has been paid for top 20 versus average. Now, if you look at this black line here, it keeps crossing over, doesn't it? No real difference, jumped up a bit there, came back down. If we look at this year here, the top 20% on average received less dollars per kilo. And we've seen that on and off through the year. Sometimes it's higher. Again, what this tells us really loud and clear is that there's no relationship between price received and return on assets within a year. So if we go chasing price, we're actually chasing the wrong thing. What we do want to look at, and what has a much stronger driver on profitability and something that is within our circle of influence, is cost of production. And I'm using a cattle example here again. So you can see that the green businesses with the highest return on assets, consistently much lower cost of production. It's still getting up to pretty scary levels. We're sitting in around that $1.64, I think it is, something like that for top 20% versus, I think there might be $2, $2.30, $2.39, something like that for average. The scary bit with this, to be really honest with you, is that this is just direct costs and overheads. There's no interest, there's no servicing of any debt in here. And if we compare that, I'll just go back and look at price received, last year, our average price received was $2.95 a kilo. This year, if we're at, and the average has been there 2 years, $2.39. Before interest rates really dropped off, what I was seeing is that the interest cost for an average business was sitting at around 50 cents a kilo. I haven't looked at that again for a couple of years. But if we're taking $2.30, $2.40, chucking on 50 cents a kilo, we're getting up to that $2.90 cost of production, and that's just to pay your direct costs, overheads, and interest. And so if you're up in those levels there, it's definitely an area to have a close look at. Top 20%, we're still operating at a very different level here. I think this cost of production is such an important number to look at. This is a fascinating little trend, and this is updated for our benchmarks that we've just run for this year. And we're going back and using 1999 as a base point. And if we look at the price received as measured in ProfitProbe, as we've seen, we're up and down, and we're going up very high levels here now. So our price received, if we jump back here, 1999, there's our starting point, 100%. Through these 2000s, we're sitting at about a 50% increase, so 150% of where it was in 1999. Went up to 300, back down to about 240, and now we're up to that 350, 400% of where it was in 1999. So we've got that fluctuation. We've seen that, and you're aware of that. What's fascinating is if you look at the relative change in cost of production on the same basis using 1999 as a starting point, price received went up, cost of production went up. Price received stayed flat. Cost of production stayed flat. Price received went up, and you can see this trend here. And when you do statistical analysis on it, this R squared, this correlation measure is 0.79, which tells us that 79% of the cost of production can be connected to the price received, or is related to price received. That's a very high, or quite a high correlation there. So what's determining cost of production? It's the decisions that we make mostly. Yes, there's external factors, absolutely. However, are we putting enough focused effort on managing and knowing what your cost of production is? Do you know what yours is? If you're watching this, you'll have your profit probe. So take a good look at it, monitor that, keep challenging it. It's not an easy one to shift. I know that. However, it's one we've got to keep focusing on, because this tells me that when we earn more, we spend more, which means it's a decision that we've made. Now, where do land prices sit in this return on assets? I haven't got the data for the last couple of years there. I just ran into Will from Heron Todd White this week, and they're finalising this next year. So thank you to Heron Todd White for providing this. This is the Heron Todd White Grazing Property Index using 1999 as a base point, the same thing. And this is the return on assets as measured in ProfitProbe, so the average for all businesses. And it shows us that here's your change in land values, and here's your change in return on assets. The R squared measure here tells us that only 12% of the change in return on assets is explained by the change in the Grazing Property Index, which is an indication of the valuation. Yeah, absolutely, it's taken off this next couple of years. I'll be fascinated to see where it gets to. Just show you, this was really interesting last year when I first pulled this out, that we look at land prices and we say, oh, my return on assets are low because land prices have gone up. This indicates that it's much more complex than that. And there's a lot more factors going on behind this low return on assets. And you can see here, return on assets 2021, exactly the same as it was 1999. However, land prices shifted, which is good for your real estate business, not so good for your production business. Looking at the margin, so this is the dollars per kilo. This is the difference between price received and cost of production. So top 20% through here, sitting around that dollar. So getting paid back there, $1.50 a kilo, and they would have been, their cost of production would have been 50 cents a kilo. So their operating margin in there, seeing the same sort of huge variation against price received. But we're sitting up around that $2 mark there. Average is still very nice. What's yours? What's your operating margin looking like, and how is it trending across time? Is this gap tightening up, or is it becoming less with time? Just finishing off now, and then we'll have plenty of time for questions if you'd like. This is just digging into this, what's happening with this cost base. This purpley line here is what's happening in the direct costs per animal unit. And this blue line here is what's happening to overheads per animal unit. So we can see on a per LSU basis, overheads are really taken off, as we looked at there before. Top 20% leveled out through here. Average kept going. And direct costs, they've kicked up but then plateaued here. And I'll just unpack this. So if we look at the direct costs one, you can see here this maroon line. That is your direct costs in animal health. And it's just been slowly increasing, back to about $2.50 there, sitting at $5, and now it's getting up around that $10 mark there now. So just gradual increase in your animal health costs per unit. The blue line is supplements and fodder. It's pretty high through those 2000s on a per animal basis, dropped back off, and then what we saw with that really widespread poorer seasons, and also with the really high prices. I think that both of them contributed to this. We saw the direct supplement and fodder go up to $45 per LSU, which, if I jump back here, not too long ago, I was actually saying that around that $30 to $40 total direct cost per LSU was a good level. So 30 to 40 total direct costs, and then we've seen supplements and fodder as an individual cost item go up to 45. And it's come back off nicely there now to 30, but we're still spending a lot per unit. And this is across sheep, cattle, all livestock sectors. The green one here is freight and selling now. You expect that your selling costs are going to gradually increase, and also we've seen our freight costs increase. So that's been the biggest consistent mover through here. So when you're doing your gross margins, make sure that you're just using current valuations. It's really common, I see, for people to say, oh, it only cost me $10 to get them to the feedlot, or it only cost me $15 to get them to the works. Is that what it was back here? Because we only don't have to go back when it was different. Or is that what your actuals are now? Because that might change what your best decision is. If we look at overheads, and overheads we're looking at as a percentage of gross product. I'm not going to break them out to a per LSU basis. I think this is a much more meaningful way to look at it. The green lines here are looking at admin and land overheads as a percentage of total gross product. With the healthier gross product, they've come off a bit here. Your buildings and plant here in blue, no significant trend there, is there? The one that's really shifted as a trend in this last 20 years has been the labour-based one. And this is taking into account paid and unpaid. So it's the full cost of labour in the business. So that's the one that's increased, which is where that gross product per FTE, your labour efficiency one, is an important one to know for your business there. What's interesting, if we're looking at these overheads, is that the overheads per LSU are taking off like a rocket for average. However, your overheads as a percentage of gross product, except for labour, haven't really shifted. So on a per animal basis, yes, it's changed, but in terms of the value being generated, not so much. However, if we start to see the market come back from, we've got Eki operating consistently over 1,000 cents here at the moment, what's the new norm? I've got no idea. If that comes back to 700 cents, which is across time, it's still a very healthy one, I suspect that these graphs here next year, or whenever that happens, are going to really kick up then. And so we'll see that impact across both. When you're looking at Probe, just remember that they are historical. They're in the past. You can't do anything about them. You can't change them. So therefore, it's important to use them to learn from the past and help navigate and direct your future decisions and your future questions. I really hope you go through your reports and use that to prompt some new questions. And many of you have heard me talk about how business analysis doesn't tell you what to do. It doesn't give you the answers. It just gives you some different questions to go and ask and discuss and use. Start strategic and then finish tactical.